So how much should I salary sacrifice? This is an important point that the mature age worker tax offset has been cancelled this year. There also was announced in the budget they were going to get rid of the senior Australians and pensioners tax offset, but they haven't got that through the Parliament as yet. So for those people who there used to be a difference in your tax-free threshold because of these mature age worker tax offset. If you were under 55, you could earn up to 20,500 and pay no tax, and if you're over 50, you could earn up to 23,000 and pay no tax. Now that the mature age workers tax offset has been eliminated, then there's only it doesn't matter if you're over 55 or under 55. It's still the 20,500 effective tax-free threshold. That's because of the low income tax offset that can apply at that rate. So let's make an assumption that we've got $44,000 earnings or employment income per year, and you're 55 years of old, which is superfluous now because it doesn't matter if you're older or younger because of elimination of the mature age workers tax offset. Now, so $44,000 per annum, how much should your salary sacrifice? Well, you could bring it down to, and I think we've just left it at the $23,000 figure. If your salary sacrifice $21,000 into your super fund, then the tax saving there is that $2,312. That's the annual benefit you could attain if you had an income of $44,000 per annum. You need to make sure that you don't exceed your concessional contribution limits, and this is a key one. If you are looking at starting a salary sacrifice strategy, then just appreciate this part of it. You can't exceed your contribution limit. You can, but there are some penalties with it. They've reduced the penalties actually, so it's not as bad as it was in the past, but there still are some penalties for doing so. So you don't want to exceed your contribution limit. It's $35,000 this financial year for those who are 50 or over, and $30,000 for those that are under 50. Now let's have a look at how this works. If you're on an income of $115,000, you might say that, well, I've got a $35,000 threshold for concessional contribution limit, and therefore I can salary sacrifice $35,000 into my super fund. But you would be, if you're an employee, you would be then breaching your contribution limit, because the $35,000 includes your 9.5% employer contributions. So you've got to deduct that 9.5% of $115,000 salary before you work out how much you can salary sacrifice. So let's do that again, do the calculation. So 9.5% of $115,000 less $35,000 gives you $24,075 that you can salary sacrifice during the financial year without breaching your contribution limit. So if you put $24,075 across into our super as a salary sacrifice, then our tax saving here is going to be just under $6,000 per annum, which is significant. But hopefully you appreciate the difference there, that we're factoring in the superannuation guarantee contributions that your employer puts in for you. The other thing is about cash flow, so making sure that you meet your cash flow requirements, and looking at a $100,000 income. We're still on a $115,000 income, but we need $100,000 to live on. Then we can salary sacrifice $24,000 into the super fund, but we might then realise that there's an income gap. We're not going to meet our cash flow requirements. Now, we could reduce the amount that we salary sacrifice. We could actually reduce that down to $15,000 so that we're meeting our income requirement here of $100,000, but we're going to miss out on $2,000 or more than $2,000 in tax savings if we do that. So what's the alternative? This is where the transition to retirement strategy comes in. We can still salary sacrifice the maximum amount, get those tax savings of just under $6,000, but to meet our income requirement, if we've reached our preservation age, we could meet that income requirement by drawing some money from our superannuation, which is effectively the transition to retirement strategy.